Okay, welcome everyone. I think we should have some people starting to join the room now. I can see a bunch of names coming through, Dan, which is good.
Yeah,
Some of
great.
them familiar, some familiar faces there or names
Yes,
coming on.
Chris from across the ditch. We caught up yesterday. Welcome, mate. Good to see you rocked up.
Good to have some Kiwis on board. Always like that.
Yeah, yeah,
Um, unless we're playing them in sport, of course.
yeah.
Um, We have quite a few on board today for this session on budgeting. And just while we've got people joining the session, we might just get a bit of a test run here on our chat. We like to do that on these sessions if you haven't joined us before. It'd be nice just to hear from everyone if you could put in the chat. We're not using Q&A, we're just using chat on this session. If you want to let us know where you're coming from, and what it is you're hoping to get out of the session today, as just a nice little starter. And as people are doing that, a big welcome to everyone who's joining us as repeat viewers. We've got quite a few people who are coming along to these sessions now each month. It sounds like you're getting something out of it, which is great. That's what we're aiming to do with these sessions, impart some knowledge, hopefully help people improve their businesses. That's what we're all about. And that they can take some tools away from these sessions as well to improve things. What a spread, Dan. We've got Melbourne, Bundaberg, Kiama, Cairns. There's Chris in Napier, in NZ.
WA.
Natasha didn't have to beam in far from Jimboomba here in Brizzy. Echuca. So a big spread. Ken looking for some tips around tighter, quicker budgeting. So yeah, hopefully we can do that in terms of the tools we've got, but also some of the processes we're going to talk about as well. So we might kick off, Dan. Thanks everyone for dropping that info in. Again, thanks for being here. I'm going to share my screen now just to get us started. So over onto that one. All right. Hopefully you can see that okay, Dan.
Yes, we're firing,
Okay.
mate.
All right. So just a bit of housekeeping at the top of the session. The agenda, what we're going to be covering today, I'll just give you a quick wrap of what we're about at Xact, if you don't know already. We're going to talk through, Dan's going to give us the business case for why you need to have a budget, what we usually see in the market in terms of how people are doing things if they don't have a budget. And then some of the really important reasons why having a budget in place is such a critical thing to have. We're then going to talk through, it's all well and good to have a budget, but what are some of the precursors to having a good budget process in place? So a budget just doesn't fall out of the sky. What are the sort of business processes you need to have to make that budgeting process more accessible? So we're going to go through that. And then Dan has a great budgeting tool. We'll be making this tool available along with the recording after the session, so that you can drop all of your own data into the budgeting tool. And so Dan's going to be walking through that tool and presenting some scenarios as well that we often see in the market. So that's the agenda. In terms of how we're going to run the show, Dan is really the main show here today. Throughout, we're going to have some polls just to keep things interactive. As I said, we will be making the recording available after the session too. We'll be emailing that hopefully this afternoon, a link for that. Questions, we just tested the chat, that's working. So if you have questions, please put your hand up or just drop it into the chat really as we go. That's a metaphorical put your hand up. What I'm really saying there is put your question into the chat and we'll try and deal with it as we go. And when Dan sort of comes up for air at the right spot. There is no such thing as a silly question. Please ask. This is a good opportunity. You've got a lot of expertise in Dan here today. And so please any kind of question we're happy to field. Some of them get pretty specific though. Once we get into the weeds of, I'm using this particular job management software, or my accounting stack looks like this, how do I do that? So for those sort of questions, we will do our best, but I think it's better to deal with those after the session. Which reminds me, we will make an opportunity at the end of this session for you guys to register your interest in having a follow-up session with Dan or one of the team in CFO advisory, if there's anything that we've talked about that you're interested in unpacking further. So just we'll have that at the end of the session, that opportunity. So a little bit about Xact. We have 3 core services. We have a bookkeeping service. We're going to find out about the importance of bookkeeping a little bit later on, but really bookkeeping these days is all about technology. It's all about having all of your systems properly integrated so you've got efficient workflows on the accounting side of your business. So your job management and project management software talking to your accounting software, and then making sure that the processes you've got in place are producing accurate, reliable data. If you've got that, then we can plug in something like our CFO advisory service. So with really reliable data in play, our CFO advisory team work on the commercial side of the accounting stack. So they're not interested in tax, these guys, whilst it's important and needs to be factored in. The CFO advisory team are all about financial visibility and ultimately profit improvement. What are the things, now we know what the data is saying, what do we need to do from a solutions point of view to change the profit picture for your business? So that's what CFO are about. And then finally, of course, we have a tax team as well who are very involved in tax and structuring. In Queensland, we do a lot of QBCC compliance work, same in New South Wales and other jurisdictions around home warranty. But also for our builder-developer clients, some very interesting structuring that we do there to make sure that when you've got those projects in play, you're limiting risk if there's a project failure, but also making the most of the tax opportunities that come from that kind of developer work. So that's us. Thanks for listening to all of that. Today is all about budgeting, and our presenter today is Dan. Dan has had a commercial road into the accounting world. He is a CPA, so obviously very qualified an accountant, but rather than working in a public practice or tax setting, he's worked in commerce. So he's worked in many businesses, some quite large ones like Bunnings, where he's held senior financial roles, and really for the last sort of coming on 5 years now, he has been completely entrenched in building and construction, has seen under the hood of, I would say, almost 1,000 businesses in that space now as well. Has an active client portfolio, as do the other team members in his business, and we just live and breathe building and construction. So Dan's going to be sharing those insights today. We're going to start though just testing our polls. So we have a quick little poll just to get going with to begin with, which is on budgeting. It's quite a broad question here, but we just wanted to know from the audience today, a couple of questions. So do you have a budget for your business? So that's a yes or no. And then the next question here is, do you update your budget each month with your actual figures so that you can measure your performance? So it's one thing to have a budget, but are you building in those actuals each month? Do you have a habit around that within the business, a process in the business where you're factoring in that sort of job level data in particular, so that you can see how you performed against the budget? So just looking at the numbers coming through here now, Dan, I'll share these results. So we've got 58% are saying yes, they've got a budget, but only 25% are uploading their actual figures. That is a bit of a mission to do that if you don't have some of the hacks that we're going to talk about today. So It's I think you're in the right place, audience. This is the sort of stuff that we're going to be helping you out with today. So thank you for that poll data there.
Yes.
Okay, Dan, we're going to jump over to you now, and we're going to start to work through the budget content. Over to you, mate.
Yeah, thanks very much, Phil. And obviously thanks everyone for making a bit of time to jump onto this one. I mean, if you are in scale up mode in your business and you're sort of trying to build a bit of direction, how big do we want to get? What's our term? What's our starts? What does the future look like? I mean, I can't stress how important a budget is for your business. So well done for rocking up to this webinar. And again, as Phil mentioned, please drop in comments as we go. We'll do a bit of a Q&A throughout and at the end, and please shoot through some pointy questions as we go, big or small. So I'll push through these slides fairly quickly because I'm pretty keen to get to the financial model, but I just want to lay a little bit of groundwork here first. And then this is normally what I see, especially coming from big business to small business, how small and medium-sized business owners are sort of steering their business. They might have gotten over the sort of $2 or $3 million turnover hump, but they might have had one or two starts. They sort of like press up to 3 or 4 starts a year, 5 starts a year, depending on your business model as well. And financial visibility gets weaker and weaker, lower and lower. Job costing is pretty average. Bank recs are done, 1 or 2 months after the fact or coming up to BAS time. And look, the only sort of real precursor that I see business owners see, probably 8 or 9 out of 10, to be honest, when I bump into them for the first time, is they use their bank account as the scoreboard. They go, hey, I've got plenty of cash, stuff must be all right, or hey, I've got no cash, stuff must be diabolical. And I just can't stress enough that cash does not equal profit. For example, you might be lucky enough to front load contracts. You might get a large deposit and a large stage claim, and you might be sort of 500K into a resi bill, but you might have only spent 200. Well, guess what? You haven't made $300,000 profit. That's just not the way it works. I mean, it's all driven by margin. So cash just doesn't equal profit. Commonly, the gap in between, and there's a separate webinar on this as well, is work in progress. So if you aren't doing WIP in your business or anything like that, I mean, I can't stress how important that one is as well. But this is a budgeting webinar. And finally, is where I do see people go, hey, well, the cash scoreboard's a bit scary. I'm going to have a crack at my own budget. I sort of call it the back of the beer coaster MBA. So they go, right, I'm going to look at my profit for the month. I haven't done any claims. My costs are really high. I've got to push this claim out next month. We're coming up to Christmas. I've got to do a big claim here and this and that. And it's a fair bit of horse trading on the back of a napkin. I mean, there's no reason why you shouldn't be running your business like that either as well. I mean, I guess proper accrual accounting is pulling revenue and cost into the one period and going, am I making profit? Yes or no? So we have a couple of webinars around this one, but we have to get away from back of the beer coaster because as you get bigger and bigger, the risk gets bigger and bigger as well, and you're only going to scale problems in the background. So step one, square one is obviously having a budget in place, starts, builds profit, and are you making the right amount of return? Either a major shareholder or a stakeholder in the business, yes or no? And I'll talk about that one very shortly. Phil, if you can just jump to the next slide, mate. If you're there. Thank you. So the importance about budgeting is budgeting is all about the future. So what are my jobs? What are my people? What are my carpentry team loads? Have I got enough starts to them? Have I got the right people in the right roles? When do I need to make, the right hires at the right time? Have I got overhead bloat? Yes or no? Do I know my numbers? Do I know my metrics? And it starts to demystify the future. So instead of having a bit of a guess and going week to week, am I going to make payroll? How do I bring this claim forward? You can map out the business's future and progression really cleanly. Again, it's never going to be a super easy road. It really is. And again, budgets will change as soon as you create them, but you have to have some sort of measurement stick to go, am I making the right profit in the business? Have I got the right cash flow coming in? Am I making the right hires at the right time? It's also a really good early warning system. So, for example, if you were due to make 50 grand profit over the next sort of 3 or 4 months, and you get to your first month and you make 30, you get to your next month, you make 25. Because at the end of the day, I mean, I don't really care what your profit is. You could be making 5 grand profit or $100,000 profit. What I care about is the quality of the earnings. So what I mean by that is ideally for every dollar you generate, you're as a builder, and this is generally speaking, and I'm happy to talk about this later, you should be making about 10 cents on the dollar as far as profit goes before company tax. Yeah, I guess coming through the business as well. So I want to know, what are we planning to make, and then did we hit it? Yes or no? So we're planning to make 50 grand, we made 25. Well, we know there's some problems going on in the business. And this is assuming you have the right bookkeeping and job costing and WIP in place. I want to know, well, how do we plug that gap? Have we got a throughput issue? Have we got an accountability issue? Because we have this beautiful budget that goes, we should be making this much money at the end of the year. These are our right times and levers to employ the right people or scale up or roll out a bit of tech or birth another carpentry team. I don't mind what it is. But we have to have some sort of measurement stick in place. Otherwise, we sort of bump into our numbers by accident month to month and go, oh my God, I haven't got enough cash for my BAS, which is usually when the cash offs do come through. And ultimately, a really good budget is a roadmap and a scoreboard to go, am I on track? Yes, no, or otherwise. So again, profit doesn't have to be a dirty word in business. I mean, shareholders need a certain return. Obviously, if you're making money, that creates options, it ensures that your business is viable, the family's protected, etc. But step one, square one in large businesses. Well, how much money do we want to make? And then we work backwards from that and go, well, what's our, how many stars do we need? What's our growth? And it's our scoreboard. We don't want to bump into our numbers by accident or bump into the cash by accident. Because I want to look at the cash and profit and go, did we hit a target? Because if we hit the target, well, that's a different level of conversation. The business versus high fives and hugs. Let's get on with it and just rinse and repeat what we're doing and micro measure ourselves against that budget as well. Next one, please, Phil. So what are the foundations of getting this right before we even kick this off, I guess, in the first instance? So step one, square one is having really, really, really good data in place. So what I mean by that is you have strong bookkeeping processes in place. You have a really good end of month close. You don't have open POs from 6 months ago lying around. You have invoices in from trades and suppliers. Everything that sits up in direct costs or cost of goods sold, and I'll talk about the delineation between COGS and overheads a little bit later on. Everything sitting up in COGS is job costed one way or another. So there's no lazy bookkeeping or lazy transactions in the background. Everything is married to a project one point or another, especially when it sits up in COGS. Or if you have something like roving supervisors or leave or stuff like that, there are exceptions, but you have to have good data. Otherwise, rubbish in equals rubbish out. So, for example, in my CFO advisory capacity, bookkeeping is absolutely critical to what we do because if we have rubbish data, how do I explain margin and profit and WIP and all those other good pieces? And then how do we make decisions from that? So I can't stress how important good data is. And to be honest, if you are a owner on this call or you're a construction manager or a head of or GM, I mean, data is your responsibility. It's not the bookkeepers or anything like that. So you have to make sure you have the right people, the right processes, the right closeout to ensure that you can get good visibility, and good visibility can turn into good information for decision-making purposes. And the final piece is obviously the right people on the bus. So what I sort of see here too, and this is a bit of a generalization, when you go from a small to a medium business, say from like 1.5 mil to 4 or 5 mil, you sort of kept the bookkeeper around or kept the site manager around. You guys are mates back in the day, 4 or 5 years on. That's not keeping pace, but you keep them because obviously you sense a bit of loyalty in there. And again, we have to sort of really separate the delineation between obviously you being a good person, keeping people on board versus what's the best business decision to take you from A to B, reduce risk to ensure you're profitable, right people on the bus as well. So you will have to ask some hard questions during the business's life cycle when you go from 1 to 2 to 5 to 10 or whatever the ambitions are. And you have to have serious conversations around swapping C players for B players and B players for A players as you get bigger. The brand gets out there and you can attract better talent. So having the right people on the bus is very important. And Phil, next one, mate, please.
Okay, so we're going to run our next poll here. So the next one we're going to find out about is what your cost tracking and job costing processes are like. So Dan touched on this. We're kind of laboring the point on this one because your budget is going to be really hard to pull in your actual performance data if you're not tracking those costs against each project properly. So there's a few takes on this answer here. The first one is, I'm not tracking this at all. What is job costing? It's okay to say yes to that. This is anonymous data. I have no visibility per job. Everything is one bucket. So I'm sort of tracking costs, but I can't see it per job. We see a lot of people just tracking material costs, but really struggling with allocating labor to jobs. Again, that's it's a fair enough position to be in, and we see that a lot. Material and labor costs are allocated to specific jobs. That's starting to get there. So that at least with that data in play, we can start to pull that into a budget kind of frame and start to see what's going on. The final bit with job costing is comparing it to your estimate. so that you can see within that project whether you're on track to make the profit that you planned on showing. So on achieving, on landing. So there, the options there. I think pretty much everyone has answered that one. Good to see that we've actually got the majority of people, so 66%, are doing it all, are doing job costing well,
Well done.
uh, which is excellent. And no one has not has has no idea about job costing, so that's excellent. We're trending towards the more informed in this session, which is great. That means that I think the tool walking through that will be quite helpful. So that is that one now. Dan, I'll hand back to you so that you can talk us through earners and burners.
Yeah, thanks, Phil. So this bit's really important when we jump into the budgeting build because we really want to separate our gross profit and net profit and separate out direct costs and COGS. So cost of goods sold, they're interchangeable and mean exactly the same thing. So don't get bamboozled by, I guess, by those two items. And then obviously separate overheads as well. So there is a magic ratio for builders or trades or pretty much whatever field you work in, as far as like how a dollar comes in, how much you should be spending on COGS. Then obviously revenue minus COGS gives you your gross profit. And then out of gross profit, you pay for overheads. And then out of the bottom, you get a net profit as a shareholder before company tax and stuff like that, which I won't talk about because if stuff like that pops up, I'll poke my eyes out, guys. So please keep it commercial. Um, so the precursor to this is that we really have to know with all the costs that are outflowing from your business, which ones are COGS and which ones are overhead. So one group live above the gross profit line. And then this is the item that you really need to micro measure in your business as well. So COGS are people like site supervisor, builds, trades, chippies, plumbers, anything like that. Anyone that's sort of that is either on site touching it. If you're a larger build, I guess a larger business as well, and you're lucky enough to have CAs on site as well. So if you have CAs in there, I would expect you to build in some COGS recovery into those contracts too. So you might have CAs or project managers built into your prelims as well. So they shouldn't be sitting down overheads. You should be trying to recover those people in your jobs. For example, you might have two $1 million builds on the go. You need a CA for both. The CA could be $150,000. Well, you chop that wage in half and build in a $75,000 prelim line into your contracts before they go out to clients, and then obviously plus margin on top of that. I mean, normally you'd go a bit heavier than the 75 just to build in some contingency, but it depends on where the projects run over or under as well. So you have to identify those pretty quickly and then obviously make sure that your ledger's set up for that. So with your expenses coming in, you look at your profit and loss statement, there is a clear delineation between the two. Super, super, super important. So again, coming back to good data, good hygiene, good bookkeeping processes. And then you have to identify the burners. So they're the people, I guess, trades, software, whatever it happens to be, that don't necessarily add direct value, but they are a support service to the business. So, for example, obviously, I'm a burner. I mean, obviously, I add value in other ways. I'm not on site swinging the hammer, but I add commercial advice elsewhere. Your bookkeeper is going to be a burner. Software is going to be a burner. Rent, if you're renting out a site as well, commonly tool or trade vehicles, especially for people that are rovers or the owner. So the owner might be off the tools driving a Land Cruiser or something like that. That's going to be an overhead as well. So both really, really, really important, but both do impact the bottom line. But it's getting those ratios right because it's really easy when you are going through scale and growth to chuck on a heap of people and tech and roll out Procore and Wonder Build and all sorts of other stuff, and you will get overhead bloat in there as well. So there is a magic formula that tells you whether you're on track or off track, and the budget helps map that out for you.
Um, Dan, we were going to run another poll there around knowing the difference between earners and burners, but I'm just going to make the call that I reckon
We should
that
be
you've
safe.
covered that really nicely there, and given the sort of sophistication of the people in the room, that we've got that. So we might, if it's okay, we might move through now to actually looking at the tool itself and walking through, some of these processes around updating the budget. So you can take over sharing now if you like.
I will fire up. So is that coming through okay on your end, Phil?
I'll stop mine. Yep, I got it, mate. Perfect.
Okay. So everyone, please drop in questions as we go. I'm going to apply the assume nothing rule here that we're sort of starting from scratch. I'll talk about the fundamentals. I'll talk about how the tool works, how this rolls up. And then what I'll do, which is a bit different to normal, is I've actually got a bit of a worked example here going, me as a builder, I've dropped everything in and those magic ratios still don't work. What do I do? Because the numbers don't stack. I'm not generating profit. I have overhead below. What are some of the levers that you can pull to try and make this business work? So I'll jump into the tool first. So this is going to be very, very, very similar to what you guys will be able to download at the end of this webinar. And again, please drop questions in there into the chat as well, and we'll answer them as we go, and obviously at the end too. So what we're looking at here is a 12-month profit and loss forecast or budget. Like they're pretty much interchangeable. This hasn't got anything to do with cash flow. It hasn't got anything to do with the balance sheet. So this is strictly profit and loss statement overall. So we have a 12-month rolling budget or forecast, again, both exactly the same. And then over on the left-hand side here, we have our profit and loss statement. So we have income, and then this is split between existing jobs and new jobs. And I'll talk about how this works very shortly. We then have cost of goods, cost of sales, direct costs, again, all interchangeable. But we're really clear on, well, for each invoice that we push out for each job, what are the direct COGS or cost of sales, direct costs? And then obviously one minus the other will then give us our gross profit. So again, this is a bit of a nice formula here. It's nice and linear. I mean, commonly in building construction, there's a bit more ups and downs on this, but this is just for demonstration purposes only. But again, I'm assuming that everyone sitting up in COGS here is fully job costed, unders and overs and leakages. I'm not dealing with that one today. We're just trying to build out a plan and a forecast to go, well, based on our existing jobs, some jobs that we have in the pipe, does this business model work? Yes or no? Now, there is a section on here for other income, but generally it's peanuts for a business like this. I wouldn't spend a tremendous amount of time getting this section right. But if you do get apprentice rebates and stuff like that, just manually override them. And then coming on down to overheads here, I'll spend a little bit of time talking about this section, but overheads are mapped out here on the left-hand side. So I would encourage you to hammer this into your ledger style and type. So what I mean by that is, I mean, if your ledger, I guess your P&L is set up differently in Xero or Mob or whatever it is, like don't try and force it to look like this. You can customize this budget template, obviously, so it's fit for purpose for your business as well. A bit of a hot tip is that if you have more than sort of like 20 overhead lines, you're probably overcooking it. Like if you got a fuel account for every vehicle and this, that, and the other, yeah, you're probably going a bit overboard. I mean, unless you're a monster business sort of turning, 100, 200 million, I wouldn't go down to that level. Because again, I mean, the quantum of money that you spend in overheads, which I guess in this example here is 47 grand versus $391,000 up here. For every hour you spend thinking about overheads, I'll be spending about 20 hours up here thinking about how I defend my margin, how I extract more margin, how can I do this job quicker, how do I get this job from 14 months, to 12-month build, et cetera, et cetera, et cetera. And I usually sort of find builders or, trades or business owners that are coming through at the moment, overheads are usually managed to within an inch of their life. Phone plans are really tight, the rent's usually pretty good. Where you're going to move the needle is up in this section up here. So these are all your overheads. And again, I'm assuming we got the earners and burners right, because again, if we don't have that right, it really upsets these numbers. Then there's a little section here for interest and depreciation, generally immaterial, but it depends on how much you leverage the ATO or debt facilities, but just have a bit of a crack at that. And then finally down the bottom is your net profit. So we go revenue minus cost of goods sold is gross profit, less your overheads. That then gives you your net profit before tax. So coming back up to the top up here, this is all your trading income, and how I would encourage you to build this is splitting it between existing jobs and new jobs, and then cost of sales, cost of goods are just a formula directly off this sales pipeline. And I'll change gears and talk about this one now, actually. So this is probably where you're going to spend a lot of your time playing. I wouldn't spend a huge amount of time playing in overheads, as I mentioned before. And we really want this to be data-led and an evidence-led budget. So what I mean by that is, you can start this budget process whenever you want. It doesn't have to be right on July. You can start it now if you want to and sort of push it forward 12 months. You got to March through to February next year, whatever it happens to be, but you need some sort of measurement stick in place and an accountability tool in place to keep senior leaders and managers on track to task and delivering the projects in full and on time. So I'm going to assume that you have like a Build Xact or a Procore or a Wonder Build or something else in place as well. So you should be able to drop in your existing projects in here. So just drop them in live. Pick a bit of a starting peg as well. So if you want to kick this off from March, just relabel this March going forwards. List down all your active jobs here. And again, you can insert more rows. So like if you're a high volume builder or you're doing a bucket load of bathrooms, just insert more rows in there so you can pad this out further. Drop in the project, client names, commencement dates. A really important driver for the spreadsheet as well is getting the gross profit right. So I can't stress enough that this isn't markup, this is gross profit. If you're unsure what the difference is, send me a chat or a note and I'm happy to talk about it. But we have this GP and markup calculators all over the place, but this is absolutely gross profit, which is really important for calculating COGS and a few other items. And then what we want in here is that we want the revenue of the contract, including variations, an estimate for provisional sums, PCs in there. So what is the total contract value ex GST? So we don't budget with GST in these profit and loss models because the GST obviously goes to the government. So we want ex GST in there. And depending on where you're sort of starting to, some of these projects might be underway. So just be really careful about going, well, if July is going to be our kickoff, and let's just pretend we're in June, or now's a really good time to sort of get this budget process in place, work out what you have built, and then obviously one minus the other will tell you what you need to forecast. Now, this is only going to be as good as the effort that you put into it. So similar to personal training or going to the gym, if you have a nice plan and a meal plan and someone to keep you accountable and you micro measure yourself, then it's really effective. But if you get a plan in place and then don't follow it and smash bags of chips and all the rest of the world, this budgeting process is going to be pretty weak overall. So ideally, you'll have a construction schedule in place. This will then tell you where the major stage claims are going out. If you're running a cost plus business, this should be fairly linear as well, and the budget model will still work for a cost plus or whether it's stage claims or anything like that too. So you can forecast out where the claims are. So I would encourage you to bring in your site supervisors, site managers, construction managers, project managers to contribute to the budget, just so you do start to build accountability into those teams as well. So, for example, here's 123 Fake Street. Here's our 12-month. This is the lumpiness of the cash flow as it comes in. When are we going to get these claims out? And start to map these out and obviously get feedback from the business because obviously you want them to contribute so then they feel accountable. And at the end of the day, probably what I care about most is, well, where's PC date? So in my world, with my CFO hat on, I don't really mind if these claims move around in the background, but we can't move that date. Because obviously when that project wraps up, we know what our margin should be. And where businesses can run into a fair bit of trouble is they might have this beautiful plan in place, but then it might push out to July. So you're still generating the same gross profit, but it's spread over a much wider area. So your gross profit per month goes from that to this. And overheads obviously don't move. And then that's where I guess you start to fail as far as hitting net profit goes. So that's why this process is really important to map out for each of your existing jobs. Map that out and see where it lands. Pushing on further down here a little bit, this is where you start to build in a bit of blue sky. So these could be new projects that you have signed and that are yet to start. And as you can see here, for example, for Flinders Lane, it's a 20% margin project, 2.5 million. Come across to the right-hand side, that's kicking off in December with a deposit, and then away we go. And then similar to new project two, same. So this can be a dynamic forecast as you go. Keep on building in projects, and you can build in blue sky as well. So if you've got a tender on your desk, that's very, very, very high likelihood of landing. I'd build it in because what we want to try and work out is have you got enough starts, enough gross profit, obviously to pay for overheads and to make sure you take home a fair earn as well. So do spend a bit of time in here building this out. If you have 4 or 5 starts on the go and you have 15 tenders landing on your desk, like don't build in 15 lines, just build in the ones that have a very high probability of landing. If they're fresh, and again, you're going to go from a business turning 5 mil, 15 tenders, you could have 40 million sitting there. I mean, this budget is just not going to work. So just make sure you do apply a bit of reasonableness over the top. So once you have built out the existing projects, it makes sense. You can see what your income is per month, and we'll around a little bit depending on where the stage claims are. But ideally, this does pop out of the back of a construction schedule, or absolute worst case, and can be a bit of the back of the envelope. But we need some sort of plan in place to measure success in this business. We've had a bit of a crack at forecasting out where some of these new jobs are. This one here is definitely signed. This one here is a 99% chance of landing, in quoting, going ahead to D&C. Dropping comments as well to help prompt you with what's going on. And then the back end of this, the cost of goods sold side is all formula driven. So again, this isn't a cash P&L. So where you have like a weekly wage, some months you might have 5 weeks, some other weeks you might have 4 weeks. I can't stress that this isn't cash. So everything that's sitting up in COGS will be accounted for in this process. What we're trying to do is measure profit. And I can promise you 9 times out of 10, 8 times out of 10, depending on a macro event or something, if you micromeasure profit, cash as a byproduct works out most of the time, 9 times out of 10. So COGS will self-calculate in the background, assuming you have good data, good hygiene, you're not confusing GP and markup, et cetera, et cetera, et cetera. So you don't have to worry too much about the COGS side. So this will calculate for the existing jobs plus anything else you got populated in there. So coming back to this front, I guess coming back to the revenue profile sheet, you can see this builder here has some decent jobs on the go. The margins smell and feel about right as well, 19s and 20s and 21s. So coming back over here, funnily enough, if it's a big revenue month or a small revenue month, you'll notice that the GP gross profit margin does hover around about 20%. So the way that works is that for every dollar you're generating, you're spending 80 cents on cost of goods sold, 20 cents at the bottom. So that's what that percentage means. So don't get bamboozled by GPs and MPs and all the rest of it. All this means is that for every dollar you generate, you're spending 80 cents, and then you're keeping 20 cents for every dollar you generate. So this number here, I couldn't care about too much, although it's important to pay for overheads. But I want to see that you can defend margin, and then that's going to be your measuring stick to go actual versus budget in that area.
Just quickly, Dan, there's just a couple of questions here.
Yeah.
And I'm sure people are kind of also trying to mull over how do we get the data in, which is always a fun game to play. But one of the questions there's a couple from Andrew. So he's saying that the first one is, do you manually input this data or can it be imported from zero? I think that was around the overhead expenses.
Yeah, I'll transition to that one in a second. I mean,
Yeah.
but you can input it in. So, for example, these are the fixed entries here, and I'll probably talk about this probably in the next couple of minutes. But you can just export a P&L, copy and paste that straight in, and then this will auto-populate in the back end. Yeah, so there is a little bit of automation to this. Like it's not going to be a grind to get up and running. First cut will be, but yeah, once it's up and running, away you go.
Yeah, I think this is one of those flywheel things where the push is a bit hard at the beginning, but it gets easier once you've already input those data, that data, and you've got all your ledger accounts there. The
Correct.
the other one was the build in prior to budgeting column makes sense. Is there a similar way to handle if the job goes beyond the forecast period?
Yeah, so I mean, there's no sort of hardcore textbook way with building a budget. I mean, you could have a 1 year budget, 5 year budget, rolling forecast, strategy plan. I mean, it's all the same buzzwords, right? It's up to you. I mean, commonly 12 months is a good period to sort of map out what's going on. If you do have projects that do roll over the year, I mean, there is a bit of a hidden column in here. I mean, but it's really rare to have all your projects land in one financial year. So just apply a bit of reasonableness. If you've got a $3 million build, it's going to take 2 years to do it. I mean, just map out what's going to fall inside that financial year ultimately as well. I'd recommend probably having like a 1 year budget, but if you work on some bigger projects, architecturally designed, or say you build towers, you can. And again, depending on your skill set and Excel or people around you, you can forecast this out for 3 years if you want to. Just insert a few more columns, link it up, and away you go. I'd
Yeah,
recommend just keeping it to a year.
and just this isn't like a set and forget kind of thing. This is a live thing. This is we're trying to remap and update the budget every time we get new information, particularly around where the claims are going to hit, and how you're traveling on the cost profile side of things. It is an interesting exercise though, if you want to kind of go that next layer deeper of accountability, to save off your original budget and to see how close you actually end up going to what your original forecast was, for whatever the period is that you're looking to budget for. We like to do that in our own business. Obviously, things are changing all the time, and you've got to adjust for that, and you need to get real clarity around what's happening. But it's a nice accountability piece as well, and it's a good way to inform your thinking around the way you're forecasting, and what went wrong, why did it go wrong, and making sure you don't continue to have those issues going forwards. Okay, back to you, Danny.
Yeah, thanks. Good questions. So I would just treat this process as like a bit of a data dump. So jump into your project management software, build Xact, whatever it happens to be, copy and paste them all in, and then just get the data into this piece first, and then I'll tell you how to use this tool and let you know whether you're okay or not. But this one here is a bit of a perfect example, but I will show you a bad news situation. So that's going to be revenue. So focus on that, timing of claims, etc. If you do have stuff that goes over the years, perfectly fine. We'll just don't drop it in these years, and you can expand it out past obviously that financial year as well. Now, when we do get into the admin area, I mean, if you do have more than 20 accounts, like if you're running 30 accounts or 50 accounts, it just creates a lot of noise. Again, when you look at the quantum of where the costs are in your business, I mean, I would focus on building out more COGS accounts than I would overhead accounts. Because again, what are you going to do with sort of these are the fuel accounts, apart from keeping people accountable around fuel spends and stuff like that. I probably have off spreadsheet or off zero processes just to manage people to make sure they're not filling up the partner's car as well, the fuel cars. There's other disciplines you can build into this. But if you have any more than sort of like 20 odd accounts, it's probably a little bit of overkill, to be honest. So I'll leave that with you guys to ponder. So when updating the admin section, this one is a little bit fiddly. So part one is going, let's build out our salaries and wages first. So what I'd recommend doing is running a payroll summary or like a employee report of some sort, then dropping down the people that are sitting in your business. That you can include a few more people in there as well, but drop down, their names, whether they're cogs or overheads. This is a really important driver for the spreadsheet as well. So if they are cogs individuals or direct cost individuals, we are assuming that their wages are fully recoverable on the job. For example, Daniel Wilkinson might be a carpenter. I'm worth 100 grand. I've got a project that's in there, for 12 months, nice and clean. And there's a prelim line built in there for me if I'm a supervisor or coming down to carpentry labor. Obviously, I'm on a rough in or chucking up the stick frame or whatever happens to be. So these items here don't actually impact the P&L build you're doing. We are assuming that they do fall into this category up in here. So they are fully recoverable. The important ones in this are your overheads. So overheads people sit below the line. And then in this example here, John Jones, he's the director. The business is still a little bit small. He's half on the tools, half cogs. So we've only taken up 50% of his overhead here as well. So it's really important that we get these people in the right pods because I mean, I've seen this a couple of times where a builder might be turning 3 million, hasn't got enough starts on the go. He's completely off the tools. He's paying himself 250 and 300, and that overheads line goes through the roof. So where they have a business that should be turning 20% gross profit, you normalize out the budget, drop him in there, and overheads are sort of sitting at 25%. So you can work out pretty quickly if you're getting 20% gross profit, your overhead load sitting at 25%, well, you're underwater by 5%. So we have to work out levers pretty quickly to go, well, how do we fix this? And I'll talk about that shortly. So spend a bit of time just working left to right on this. There are a lot of formulas in here as well, as you can see. Ignore those. The main ones are the names, the COGS overheads. You put down the role title, which I'd encourage you, what their wages are. And then the only sort of final thing over here is just working out whether you have 4-week pay periods or 5-week pay periods if you run a weekly payroll, because that will push the overhead number around a little bit. And then coming on down to the bottom left-hand side here, just getting that superannuation right too. I mean, each year it changes by about 0.5%. So just make sure you got the right number in there. The other important piece around this too is just getting that work cover rate right as well. So if you're in Queensland, it should be floating around that sort of 3.5, 4%. If you've had a few claims, I mean, that can shoot up pretty quickly. New South Wales and Victoria are pretty savage if you do hurt someone on site or if you have like a lost time injury too. So just be really careful around that one as well, because you want to make sure you have the right overhead load, the right cost of doing business in there. Now, once that is all built and then that is mapped out to the right hand side, again, the cogs won't really have much of an impact to the P&L overall. It's going to be that overhead line that pulls on through to the front. So coming on down to the bottom, wages and salaries, there's that overhead line there. There's that superannuation, and there's that line in there too. Now, as for the rest, there are 2 tabs for this. So this one is a little bit fiddly, but what I would recommend doing is jumping into your zero account or MYOB account, run your P&L, and then everything that's sitting in overheads. But just make sure you do a bit of a sweep. Like I see pretty commonly that wages just all gets dumped into overheads. And commonly there's nothing sitting up in COGS just because that's where I guess zero defaults of the wage category. Just make sure you have a chat to your bookkeeper or accounts manager, whoever it is. Just create new pay items. So like, for example, if I'm on the tools, I have my own pay item, which will then push my wages above the line, above gross margin. And then everyone else that's on salaries or hourly rate casual that's sitting in the office or similar, that you have got that delineation in there as well. So just a hot tip there. So I would copy and paste in your overheads into this column here. And then when you come across to the detail, this is where you start to build it out. So for example, depending on what you enter in there, this here will live update depending on what's entered over on this side. So if I change this and do that, you will find out that they're updated. So these are the major cost categories. And then coming across to here, you can then go, right, oh, what are the individual items sitting under accounting fees? So you could have tax and you could have CFO advisory. What's the frequency monthly? And then they'll forecast out to the right-hand side. And then same with like advertising and bank charges, however your ledger's sort of set up. You probably want to build a fair bit of evidence and data into this. Like, don't have a bit of a guess. It will be a little bit tedious at the start to get this right. But for example, once you build out subscriptions, they should be pretty standard. They just tick along monthly. Build Xact Protocol, Norton, Microsoft 365, drop them in, and yeah, let those roll out to the side. If you have got timing variances between the two, again, don't be afraid to sort of break the spreadsheet a little bit. So if you're looking at folding and build Xact, but you're not going to do that till December, just drop that in and just delete these items out there. It's pretty easy to sort of fix, or you can undo it, or just copy the formula above. The sheet is pretty dynamic. So spend a bit of time getting this accurate, line by line, motor vehicles, office expenses, etc. And that will all wrap up into here as like a nice little summary so you can see what's going on. And then it will give you operating wages, total overheads, and then there are some graphs in the background as well to sort of work out where your spiky periods are. And then when we come back across the budget, that'll all transpose into this area here. So you can see here accounting fees month on month. I mean, you can build a bit of variability into there as well. So if you have some like monthly fees coming through, and then say, I don't know, you get like a lumpy accounting fee for doing tax returns. I mean, you can override that in there just to create that variability in there. So try and map this out as best you can. Again, for every hour you spend in this section, I'd rather you spend 30, 40 hours at least thinking about COGS. So don't go chasing $10 subscription fees. Just put the meaty stuff in here overall. And then when you come on down to the bottom, obviously this line is pretty important because that's obviously the money you can spend, but probably more important is this line here and obviously this line here. So the magic formula for builders and trades is this. So if you are doing, bathrooms and stuff like that, and your margin, or I guess the market margin is running at 30% or 35%, but let's just call it 30, your overhead load, the magic formula is, GP divided by 2 minus 1. So what I mean by that is if your GP is running at 30%, and that's your market, your overhead load should be running at 14%. If you are a spec custom home builder, sort of under 1.5, 1.6, around that sort of patch, you should be getting 20% GPs all day long, and your overhead load should be running at about 9%. So again, what that means is that for every dollar coming in, you should be spending about 9 cents. If you're lucky enough to be a large commercial builder and your GPs are running at around 10%, 9%, well, again, that overhead load should be sitting at around about 4% overall. So they're the magic numbers to go, is this right, yes or no? Because some of these can bounce around overall. December is usually pretty damaging because there's no claims. April can be pretty damaging as well. But as long as overheads are landing at 9, and then this number down the bottom here is landing at least 10%, again, assuming your margin, I guess you're a spec home builder, custom home builder at that 20% margin, they're the magic ratios.
You want to just run that again, Dan? Just what that formula is? There was a question
Okay.
around just repeating that yardstick from GP to overhead.
Yeah. It's a good one because I don't think I touched on that in a previous webinar. So depending on what your market margin is, so gross margin, not markup margin. So say you are bathroom specialist and you're running at 30%, so you're comfortable and you know it. If you're unsure what your margin should be, send me a message or catch up with me and I'll tell you what it is because we've got a lot of evidence behind it. Your overhead, the formula needs to be half GP minus 1. So this number here needs to be 14% or better. That there's just good. I want to see great. So then your net profit will ideally be 16%. If you're a custom spec home builder running at 20s, I want to see that running at 9 or 8. 8 is gold star. And then your net profit down the bottom, you can work out the formulas. 20% minus 9 is 11% net profit. So for every dollar you generate, you should be keeping 11 cents. And in this
And
instance
these are
here,
sort of benchmarks, like obviously it
correct.
depends on what's going on. If you're going for a lot of growth and maybe still waiting for some jobs to start, you might be taking a hit, but it's gonna come off at the back end of the period. So it's really these are
Yeah.
benchmarks.
Yeah, it's a heuristic and a rule of thumb.
Yep.
Growing is very expensive, so obviously overhead's going to get smashed until you get the right payback. And again, this is just a bit of a 101 chat on the budget. There's heaps of different conversations you have from this because you might say, hey, I don't want to stay at 6.8 million. I built out my contracts, built out my pricing. I'm actually okay with the work that I've signed. I want to get to 12 million. Or you might have a chat to your business partner or better half, wherever it is, and go, right, oh, we want to charge to $1 million. So this is cut one. And then we go, okay, well, what does that look like? We fold in another build. What is the admin load that we need to support it? Because you might find that you might fold in another 12 million. I had this conversation recently with another client, actually. He's running at around about sort of 16% GP, but his overheads are running at 5. And I'm like, mate, you need to spend money. You need to fold in processes, fold in tech. You probably need a CA or a PM in place because he was cooked. He's going, oh my God, overheads, overheads. We did the budgeting process. I'm like, no, no, you need to spend some money so you get A, time back with the family, B, you're not doing 80 hours. And then his back office staff were absolutely getting smashed as well. So as long as you maintain and defend those margins and ratios, you can recut this and go, well, what does my business model look like going forwards? That's how you use this. And then most importantly, after this is go, well, don't just do all this effort and energy, similar to personal training, measure yourself against it. So the easiest way to do that is that you can load these budgets into zero. So your bookkeeper should be able to help, or our bookkeeping function should be able to help. And then that's assuming you got WIP and all those other nice things in place. And then measure yourself against these targets. Keep your team accountable. Micro measure yourself against it. Because at the end of the day, I mean, I care about what the target is. I builders say, hey, I make 100 grand a month. I'm like, okay, that's nice. But they say, hey, look, my margin's 20, but I'm making 2% net profit. I'm going to go, that's bloody rubbish. Bank interest is better than that as far as rates of return goes. Whereas if I have a builder saying, hey, I make 40 grand a month, but my profits, 12 or 13%, and they start at a GP of 20, I'm going to go, that's awesome. How do I invest?
Yeah.
Hypothetically, we don't do it, but
Quality of earnings
quality of
and that
earnings.
improving over time. While we're in benchmark land, Megan's client of ours, Megan Cocker, she's interested in margins for renos and what do benchmarks look like there, and so GP and overhead.
Yeah, so good. Another good question. It depends on the size and scale of the
Yeah,
reno. So if you're doing 100K renos versus, I have a couple of builders doing $3 and $4 million renos, that'll be different. If you're sort of sub 800K, it's sort of sub 700K. So let's just come back. Anything below 200K should be about 30-35% all day long. Generally anything that's sort of up to around that sort of 500 to a million, you're still sort of pushing 28s, 29s. Um, Up to about 800K. And then from about 1 to 1.5, you're probably landing at around about 20s, 22s. And then anything above 1.5 is, diminishing returns after that, like 18s and 17s, etc.
yeah,
That's a
they're more like
rough.
a new build really at that point, aren't they? In terms of the margins that you're looking at, the quantum of the project is pretty significant. The size of the
Yeah.
work.
Yeah, correct, exactly right. So, I mean, happy to have a separate conversation on that one because I'd be interested to have a look at the business and sort of see where you're landing. And
Yeah,
again, that's a bit of generalization as well. But I mean, generally, the smaller the builds as far as revenue goes, the higher the percentage. But obviously, the larger the builds, you're not going to get away with a 35% margin on a $3 million build because the GP dollars will be tremendous. So it's a sliding scale, is the way that works. But I mean, we've got enough evidence that I can probably rattle off a few of those depending on the size of the renos that you're doing. Hope that answers the question. So just quickly, I have a quick example here to go, well, Dan, I've gone away, I've rewatched the webinar, I've input all my numbers, and I'm worried. So I've dropped in my revenue profiles, my admin expenses, my salaries and wages. And then the most important, and again, this is a custom spec home builder, so they should be making a 20% gross profit and at least a 10 to 12% net profit. I've dropped in all those numbers in there. The barometer to work out, is my business okay? Is this very, very, very far right-hand number here, 2%. So obviously the answer is no, we're not okay. And then we come up and go, well, where are we going wrong? My margins are really steady. And we go, okay, well that's not too bad. But I come on down to overheads and they're running at 18%. So there's two ways to fix overheads in a business. One is to cut cost. 7 times out of 10, that's usually not an option for a builder. Sometimes I do see builders with what I call overhead bloat in there. And I'll talk about an example very quickly shortly. But I usually sort of find overheads are usually pretty steady in building businesses. What I usually find is that they need to lift throughput. So what I mean by that is if you can have another couple of starts or stretch this to $7 or $8 million, still keep the same GP percent, but obviously the GP dollars go up, that's obviously going to squash that number. And I'll do an example in a second as well. So if you do the budget process and it lands at this or worse, you have to go, right, well, how do I recut this? Do I need to add more revenue? Do I need to rationalize my overheads? Whatever happens to be, how do I get this business spitting out 10% for me? Or if you're a plumber or a trade or, one of those, how do I get this spitting out, 15 to 17%? Or if you're a large industrial builder, how do I get that to 5? And then they're the conversations you have to have over and over and over. And then you start playing with the model and go, how do I get my business working and spitting out the right rate of return for me? For example, and I have this conversation all the time, and I'm generalizing this and moving through this a little bit quickly, but I can see here on average, and I have evidence to support this builder here normally sort of does, four-ish, 3.5 starts at any given point. I can see what their target market is. And then as you come across to the right-hand side, you can see, well, it goes from 4 down to 3, down to 2, down to 1. So we can see what's happening with revenue over the back here. So when I come back across to this and I go, well, how does the start of the year look? We have got a little bit of overhead bloat in there, but our profit isn't too far off. But when you come to the second half of the year, the overheads don't move all that much. Overhead should be really consistent in business. Like it's rare to sort of see them do this. But I can see here with my profit, it goes from 25s, 70s, and then just falls off a cliff over to the right-hand side. So I can see pretty cleanly that if I haven't got enough starts on the go generating the right revenue, and then you're not spending the money to obviously push those projects through, then obviously gross profit is going to get whacked. So the conversations I'll be having internally is going, well, what is in my what is on my tender list? What architects can I speak to? How's my social media campaigns going? How can I fold in another start? Because obviously 2 starts here isn't good. Ideally, you have sort of 3 or 4 on the go. If I can get another start in here, what does that do to my numbers? So again, drag that across, and a bit of this is blue sky, but the call to action is if I get this start in here, I can see. So this is how I guess overlay an operational context to the numbers, because you can clearly see it doesn't work. 4 starts, 3 starts, 2 starts. If I can get another one in here, what does that do to my profit? Oh wow, it more than doubles it. It gets it to 5%. Okay, well that's a good start. Let's say this build here, it might be a 12-month build, but let's say I can do it in 10. So if I go that and go spread this over 10 months, we get this to 250 a month. And say we can start it a month earlier, or I'll get like a larger deposit. What does that do? So then you click and drag that across, because obviously if you're generating revenue, you're generating costs, and you're generating margin. Well, what does that do? Okay, it gets us to 6%. That's amazing. Come up here. Okay, so I've got 3 starts on the go here. I've only got 2 there. What if I can do that again? So I've got this other large tender, high probability of landing. It's an 18-month build. I'm just going to be a bit lazy and spread that over 18 months, drag that across and go, okay, well, what does that do to it? So that's the conversation you have to have over and over and over and over again and go, how do I make this business model work? And as you can see, I haven't even touched overheads yet. And you can see the overheads getting crunched. So because we're generating more revenue, and again, this is about cents on the dollar. How many cents on the dollar land? So a dollar comes in, you're spending 12 cents now. But it looks like we still have overhead bloat. So let's just pretend we've had this conversation over and over and over internally. You've had a chat to key stakeholders, site supervisors, how many starts can we do? What's in your sales pipeline, et cetera, et cetera. And we go, righto. Dan's told me that my margin's 20%, which it should work, but I've still got overhead bloat. What do we do? If you want to have a separate conversation on this, happy to do a one-on-one session, but I have just done some like lazy overhead bloat calculations in here as well. So the overhead load is tremendous. We've identified that for a $5 million business, we've got 1, 2, we have 4 admin staff in there, which is going to be too much. So then we go, right, if we rejig roles, rationalize them, we had this high period of growth where we needed these people, a couple of people here, a bit of surplus to needs, or we haven't got the right players on the, I guess on the team. If we drop those people out, which were straight overheads, what does that do? oh wow, the business finally works. So that's how you use this tool, not just from a numbers perspective, but you go rinse, repeat, recycle. What if I do this? What if I pull these levers? Um, what does it do to the bottom number? Keep in mind when you are growing quickly, it is okay that the overhead number increases above 10% because growing is expensive. For example, whenever I pile in a new CFO advisor into my division, they aren't cheap, like the overhead goes, bruh, or sorry, the COGS goes, tremendously higher. And then obviously you have to find clients, get the revenue in, etc. So as long as you can sort of rationalize this piece here and go, is the core business running at 9%? Yes or no? You drop in the next head. So you might need someone, I don't know, a full-time estimator, whatever it is, overheads, and it's, I don't know, 150. At least you know the core business is running at 9 and that's running at 12. But then the next conversation I want to see is, well, I don't want to see it stay at 12. If you're adding in an estimator, how much more revenue are you going to get? Because at the end of the day, again, this is a custom spec home builder. That number there needs to be 10 to 12%. And that's how you use this tool and rinse and repeat, rinse and repeat, rinse and repeat. Because we need to see at least that 10% in the bottom right hand corner.
So that it was good. Yeah, it was good to see how you can use that to back out, what you may have a bit of operational bloat, overhead bloat, we call it. So you can use the tool to model that. If I make this decision, we might be able to automate some roles, get some software in place. We might be able to even potentially look at some offshore solutions around some of the back office work. So how will that be impacted? But also on the growth curve, if you're wanting to grow and you're looking like you might need to add additional admin or back office expenses, overhead expenses, you can start to model that out as well and start to see, rather than kind of having a gut feel approach to when do I hire and what's the financial dimension of those hires, you can really start to look at that with some more science in play. An age-old question there that just came to us, just to you and I, Dan, was someone trying to get their head around how this is going to work from a cash basis accounting, which is where they currently sit. They're not, using the accrual method, and trying to get their head around how that kind of works when we're looking at a tool like this. I mean, I think you were sort of saying earlier on, this is not a cash flow forecast. That's a different thing altogether. This is, I mean, really, it's almost like it's a financial business plan. This is, you can write lots of words for a business plan, and I'd commend people that do that, and I think there's still room for that. But this is the accounting end of a business plan and the commercial end of a business plan, and that's probably the way you kind of need to see it. This is where we're heading as a business, and plugging in your data on that basis. So you've got good visibility around what's happening. It's not going to reconcile necessarily with your cash position in Xero. So they're two kind of different things going on here, right, Dan?
Yeah, I mean, cash, cash basis of accounting. I mean, if you were Telstra or someone like that, you could probably get away with it. I've got to sell 10,000 phone plans. They get direct debitors, so cash might be okay, and that's an extreme example. The danger of builders is that you could have big claim month, small claim month. But again, the philosophy is that at the end of the day, you're going to have revenue $1 million, costs of 800, one minus the other's 200K in GP. Then how that lands inside the next 12 months, whether it's 2 months or 12 months, whatever it is, less overheads. I mean, you have to run the accrual method for that. If you are a commercial business, cash basis is only useful for lodging your BAS. That's the only thing it's useful for. And cash flows are a separate conversation, but you have to run your business via the accrual method. If you don't, your P&L is going to look like this, your cash flow is going to look like this. If you haven't got strong job costing in place, I can't tell you whether your margin's okay or whether your business is going to be okay. So I'm not trying to generate fear here or anything like that at all. I mean, you have to run your business under the accrual method, 100%, because every big business I've been part of does.
Yeah, I think there's a sort of, that's part of the growth journey, is getting to a
Mm.
point where you're doing proper month-end closes, you're aligning all those costs to the right period, income to the right period, and you get then to have the upside of all of this visibility in terms of being able to see where things are landing. We're kind of coming up on time here. What we might do, I just wanted to quickly put this poll up now. So Dan's mentioned it a few times, more than happy to take some of these things offline and look at your more specific circumstances. So I've got a poll here, or if, you're interested in talking to Dan about the services that CFO provide. I also have a question there. If you feel like your bookkeeping services aren't, or the way you're handling BK internally, you want some time back, rather than having to be Friday night trying to, punch in invoices into Xero or whatever the case might be. If you want to have a chat to us about that and implementing best practice from a job costing perspective, a lot of that sits in BK these days. Please let us know, and we can have a chat afterwards. And then obviously for Dan and his team, anything specifically you want us to have a look at, we can, or you can have a chat to the CFO advisory guys about what they do in terms of helping people. Really, Dan, it's about punching up the profit, making sure that the business is growing commercially, and you're doing everything you can to improve margins. That's what Dan lives and breathes every day with his clients, as do his team. So more than happy to have a chat about that, or some specific things as well, if you'd like us to. I might just quickly, because I'll just mention, we've got, if you can just go to the next slide there. I can do it, Dan. I can
See you,
share my
mate. Yeah.
screen. Yeah, I'll do that. We have our next event that's coming up next month, is From Chaos to Control, which is, Dan and the team spend a lot of time on the commercial side, looking at margins, all those sorts of things. That also spend a lot of time on the mechanics of building a team. We reckon you probably, if you're in growth phase, you're probably spending almost half your time now, as a business owner in this space, trying to find people, get them to stick, work on the culture, and then the other component to that is what we've touched on today, the financial dimension of building a team. How do we plan for that carefully, and again with some science rather than gut feel and emotion? So we're going to be doing that. We've got Dylan, who's one of our tax and accounting partners, on that one as well, because we're going to be talking about incentive schemes as well, and succession planning. And quite often that will mean, how do I structure the business so I could bring my, one of my 2IC or someone like that in on the business as well over time, to generate a bit of owner level thinking in the way they operate, and for them to share the rewards, and potentially, you're starting to create an asset and a good exit plan for yourself as well. So we're going to be covering some of those topics off as well in that next one. We're up on time now. I am happy though, if we did want to deal with any more questions before we jump off. If there's anything that you haven't asked, that you'd like an answer to, please drop that in the chat now. Again, we'll be sending the video out so you can watch that back. We'll send the tool as well, so you can watch the video and use the tool at the same time. But yeah, if there's anything that you want to ask now before we jump off, please feel free to do so and drop that in the chat. I think sounds like we're pretty much there, Dan.
Yeah, I think so.
I think so. Yeah. Okay.
Just
Awesome.
just a couple of parting comments just really quickly. With that budgeting tool, that's sort of step one, square one is what how you use it after that, which is probably the important piece. Like, how do you drive accountability? If you know your average time to convert a lead is 3 months, and you can sort of see that profit gap coming up, and you need another start in April, or you need to start hustling around January. It's how you use the tool afterwards. I think that's where a lot of the value sits. So yeah, definitely give it a crack. I'm always open to feedback. If there's another session that you guys want to, I guess, have us run through as well, let us know.
Yeah.
Otherwise, yeah,
There's a
definitely.
survey actually when you close out of this, as people are doing now. There's a very, very quick survey. Please, if you could fill it out for us, there's only a few questions. We are interested in the topics that you want us to cover as well. So please give us your feedback. We love doing this stuff, and we see people getting value out of it. So let us know what's keeping you awake at night, and we can see if we can cover that off for you. I think that's a wrap. Thank you very much again for joining us. I know everyone's really busy. We hope you got something out of it, and we'll see you again next time.
Thanks, everyone.
Thanks,
Bye.
Dan. See ya.